Hi, in this video I'm going to be revisiting the supply and demand order equation, and we touched on it earlier in the course when I spoke about supply and demand and basically taking trades at supply and demand levels. But I want to get into a bit more depth about supply and demand order equation, and really give you an insight into why at certain levels of supply and demand maybe you should be thinking about what other traders are doing, right, in relation to what you're looking to do from a fundamental and sentiment perspective when it comes to buying and selling. Because at the end of the day, it's about an imbalance in supply and demand and who is buying and who is selling at certain price levels, right? So we want to understand the motives of other traders, which gives us an extra I suppose boost to our trade when it comes to the amount of orders that should be in that area. Now, supply and demand order equations are really applied to technical analysis, and it's really because a lot of traders are purely technical. A lot of retail traders anyway are they don't necessarily trade fundamentals so much, but everybody trades pretty much technicals. There's rarely any fundamental traders that don't look at price charts, if you know what I mean. But there are areas on a price chart where pretty much all traders are going to be looking at either taking profit, which is going to be forced supply or demand, or entering new trades, which is willing supply and demand, right? So we want to identify those areas where there should be an imbalance in supply and demand from a technical analysis perspective, and the reasons why we want to be entering at that level, at either buying or selling. So as I've just said, there are price levels that cause imbalances in supply and demand, and just from a technical analysis perspective, and these levels really and areas are what traders would refer to as support and resistance levels. And support and resistance, pretty much all traders, 99% of traders will trade support and resistance levels, and this is from a psychological perspective. And as we know, support and resistance are supply and demand levels that have been projected into the future, right? So a lot of traders will trade support and resistance and look for key areas, what they consider key areas. Now, there are three support and resistance categories that traders will generally trade, right? And the first one is horizontal, as we know, and that is really also an odds enhancer, right? We've got diagonal, which is where traders will look to join lows, higher lows, and highs and lower highs. And then we have dynamic, which is moving averages, and then we have a little bonus one, which is round numbers. This is more to do with psychology. So let's get into just an example of, for example, a horizontal support and resistance, and you should know this, but we're going to go over the supply and demand equation and forced and willing supply. So if we look at this level here, right, we've got a level of resistance. In fact, let me just bring up my pen. So we got a level of resistance here, and we got some confirming support price action right there. Now, when prices start to break down, traders are going to be looking at this level of previous support and resistance as a level to get potentially short, right? So let's look at the motives in the supply and demand equation as to why traders, there should be more supply here from a technical analysis perspective, right? Remember, with fundamentals, we don't know what's happening on this price chart at this particular point in time, so determine value. But from a technical perspective, this is we're going to try and look into the motives of all the forced and willing supply at this area, right? So as prices go down, we've got traders that are going to pick the bottom, right? So we're going to look at forced supply first. So forced supply is when traders are buying here, right? If they buy down here, they're going to be forced to sell if prices come back up here, right? say forced to sell, and it's forced selling simply because traders are kind of forced to take profit, right, at what we would consider a trouble area, right? So if you bought here, right, let me just get this, right? If you buy here, you're going to take profit of either two ways. You're either going to take profit on an arbitrary, maybe 1-to-1 or 2-to-1 risk reward ratio. So depending on how you enter and what time frame you entered, you might be taking profits at certain areas, right? But then if you are trading up, if you're just holding a trade, right, and trying to maybe swing trade this, depending again on your risk reward, where's the first area you're going to look to take some sort of profit? Right, it's going to be an area that acted as resistance and support in the past. So, because this potentially could act as resistance, and if prices have basically made their way up, right, you're expecting what? Prices to react here. Most traders are not gonna, they're going to take profit along the way, right? So most traders are not going to want to ride this out, right, and expect to hold this trade, potentially break through a level of resistance, especially depending on the amount of pips, right, that they've accumulated along the way. It's very hard for traders to, because they pretty much brain banked their profit, even though they haven't taken profit yet. So it's hard for traders to kind of look at this area and look at a pullback and look at the amount of money they could have made at a logical area where they should have taken profit for price to pull back, and prices may not even get past this level of resistance. So the smart thing to do for traders is going to be to take profit around here. And again, if we're buying here, right, then up here is a sell, right? You're forced to kind of get out of this level. If there wasn't any support or resistance here, then traders would be looking at taking profit at any kind of trouble area. So support and resistance levels are areas where traders will be looking to take profit. And yourselves, if you've traded for any length of time, that you'd probably be looking at the same exact thing, right? So this is going to be forced selling from a take profit perspective. And then we also have traders, right, who are looking at willing supply. So traders are going to be looking at this level who haven't entered yet, didn't enter down here, and then what they're doing is they're looking to enter a new trade at what is considered resistance, support, and a new trade at what? Resistance, right? So again, if they're entering short, that's a sell, that's more supply, so that's willing supply. So not only you have forced supply, you have willing supply from new traders getting in shorts that are going to be entering based off of that level, price action, how it reacts. Some people just place pending orders at this level because they just trade support and resistance levels. And then what we have is ourselves getting in at this level of supply, right? Prices make lower highs, lower lows. We think that this is value in alignment with our fundamentals as an odds enhancer. And then what we have, right, so we've got trade entries, take profits, and we've got value traders all in one area. And then what we see, again, if we're right about this move, what we will see is prices fall away. So net, what you have to ask yourself is why there is going to be more demand at this area than supply. And the only reason why there will be more demand at this area than supply is if the market thinks that this is undervalued, as in the British pound is still undervalued, right? From a fundamental or even a sentiment point of view, or the Australian dollar is overvalued, etc., right? So beyond the price chart is fundamentals, and we base our trading decisions on the fundamentals because that's the number one odds enhancer. And then we have our technical analysis. From a technical analysis perspective, to time our entries, we're looking and trying to understand the motives of other traders and understand why there should be more supply here than demand. And as you can see, prices fall away, right? And let's look at another example from horizontal support and resistance. So we have some support there, support, resistance, supports, and then support, right? And again, this creates a demand zone at this area here. So again, let's go through some forced demand and willing demand. So again, as traders, if you're up here and you picked off the absolute top and you're getting short, right? So you're getting short here. It's a sell order, and if prices come all the way down here, you're going to be taking profit, right? So TP, your take profit equals a buy order, right? You're forced to basically take profit at certain levels where prices have, you know, reacted. So that's going to be forced buying or forced demand in that area. Let me just move this over. And then what you're going to have, not only do you have forced buying, forced take profit, forced demand going on, forced orders going on, demand orders going on there, you're going to have willing demand as well from traders entering just support, resistance, and people are going to, you know, traders are going to be looking at this area to try to look to get short. You see a pin bar here, and then you also have some willing buying, which is willing demand, right, from new traders entering on a potential pullback from maybe this low to this high. This is potentially a 61.8 Fibonacci, etc., right? So you've got the confluence of obviously horizontal support and resistance within that area, right? And then you get price reaction, and then what you have is prices end up going higher. So again, just taking into account value traders, the demand and buy orders from traders taking new trades in this area, and then we have obviously traders taking profit, and if they went short then they have to buy. So you've got a lot of forced and willing demand here. And again, the question you always have to ask when entering at a level technically is, why would there be more supply at this level than demand, right? So that's covered the horizontal support and resistance, and next we're going to be looking at the diagonal support and resistance. Now, so diagonal support and resistance is usually, again, traders, right, that will join lower highs, right, and they will join higher lows, right? So this obviously being higher low, etc., right? And they would join higher lows and highs and what they consider to be lower highs, right? So you can call these, you know, trend lines, or just, you know, sometimes you get you know, things like trend channels, where within a trend channel you could have, you know, prices do, you know, some bit of madness like that, right? And then and so on and so forth, where it might not look like an obvious trend within the trend channel, right? But traders would again potentially start joining highs, especially if that starts to come down, and then project into the future as to what they think will be a diagonal level of, you know, support or resistance, right? So again, let's look at this on a price chart. So in this example, we have prices that are making higher highs and higher lows, right? So you've got pretty much a high there, then you've got a bit of a pullback, and then you've got another high, right? So higher low, so you've got a low, then you've got a higher low, clear and obvious for everyone to see, and then traders will look to join the lows of this potential trend, right, and project into, you know, the future. And if prices come back into this level, they will be looking to buy, right? This is going to be willing demand in this level if traders are looking to buy at this area, right? Based off of projecting into the future diagonal support. So let's obviously go forward a little bit, right? So if we're looking at it just from a willing demand perspective, we have traders coming into this area here, right? And first thing I want to say is we're not looking to just take these areas of diagonal, horizontal and dynamic support and resistance randomly on a price chart. We always need the confluence or they are confluence to and secondary and to supply and demand zones. So we're looking to trade demand zones or supply zones and then look for this, if we do get any diagonal support or horizontal support or dynamic support within this demand area. So traders who obviously were looking to buy and enter new trades at this area for the trend to continue higher are going to be looking at this area. There's some demand here and that's willing demand. We've got traders who would have been entering at the highs right here, right? And if they sell to get short, to take profit, right, to TP, oh, sorry about that, it's going to be around an area where they think prices will bounce from, right? So they're going to be taking profit. If they sold, then that's going to be forced demand, right? Forced buying. And then we have value traders like ourselves, knowing that this is an area of demand, an area of potential value. Prices come into this area here, and we got the confluence of all three from a supply and demand equation. And again, and I sound like a broken record, but we have to always ask, why is there going to be more? Is there going to be more supply, right? Or is there going to be more demand from a technical analysis perspective, right? What are the motives of other traders, and why is there going to be more of a balance or an increase in demand and a decrease in supply? And what we get is obviously continuation of the move. And let's look at another example from a supply example, and this isn't necessarily an obvious trend, but in this example we would have traders that are looking at areas, again, lower highs being made. I wouldn't actually even say lower highs being made, but a level where prices have reacted from a previous high, and what you get is traders will be joining these highs, right? And traders would consider this a lower high. I don't consider this a lower high until a lower low is made, right? So depending on how you would call this a lower low, you could call this area a lower low, matter of fact. Some traders would, right? So that'd be a low, then a lower low, right? So with that being made, this level now becomes an area where traders are going to be joining that resistance and again projecting it into the future. So as prices go down to here, we create this demand zone, this supply zone, right? And again, we have to look at forced supply or forced or willing supply, right? So when prices do come back up here, what's the forced and what's the willing supply? So what we're looking at is traders who bought down here, going to take profit up here, so they need to sell to exit. That's forced supply. And new traders, right, who are trading off of this level, right, we have willing supply. And then we also have value traders like ourselves, which is obviously willing supply. Get price action, get pending orders. So again, the question is, why? Is there going to be potentially more demand at this level than supply from a technical analysis perspective and traders' motives, and from as far as an imbalance in supply and demand. And as we can see, prices do end up falling away. So the next category of support and resistance is dynamic support and resistance, and it comes in the form of moving averages. Now, if you don't know what moving averages are, the moving average is a simple technical analysis tool that smooths out price data by creating a constantly updating average price, and that's from Investopedia. So the moving average is just an indicator, right? And you've got two calculations, or yes, you've got many calculations of a moving average, but the main moving average calculations are from the simple moving average and the exponential moving average, right? And what the moving average does is just measures the average price over a period of time, and the popular periods are the 21 period, 50 period, 100 period, and 200 period. And as we are looking at daily time frame charts, what we're looking at is 21 days, 50 days, 100 days, and 200 days, right? So if you don't know what moving averages look like, they look like this, right? And what we have here are two green lines and two, I suppose, yellow golden lines. And the green lines represent the 100 moving average, which means that it's tracking the average price over 100 days, and the golden yellow moving averages are measuring the EMAs and SMA over the past 200 days, right? So 200 candlesticks. And what we want to do when looking at moving averages is look for first touches after price has gone above or below those moving averages. So we can see here that prices from pretty much this point has crossed below the 100 and the 200 period moving averages. Once that happens, what we're looking for is a first touch of the moving averages to act as a resistance or support level. So the first touch is usually the strongest touch. Again, it's not perfect, it's not going to bounce every time. This is just an indicator, and we use fundamentals to determine our directional bias. But from I suppose a technical trading strategy perspective, traders will use moving average bounces and crosses, right, as dynamic support and resistance. And as we go forward, I will show you some areas where we will bounce from these levels, right? So you've got areas here, you can see resistance. In fact, you can see a bit of resistance here. The first time it touches the 200 EMA, you get a reaction. And again, we're not necessarily concerned with the direction per se. If this isn't a direction that we want to trade in, then we wouldn't be looking at resistance. If this was a direction that we wanted to be trading in, then we would be, right? But this is just to show you that once you see a cross, or prices first cross, right, these moving averages, when prices come back down, you can see that 100 hasn't been touched, and the first time it's touched is this area, then we get a reaction. The first time the 200 EMAs and SMAs are touched, we get a reaction, right? Again, it's not perfect. Prices come back up in this area here, and then we can keep going forward, right? And then look at a bit more examples where we can see prices again fall away here, prices react around here, prices react right there. Didn't get any reaction, we did get a little bit of a reaction here, and then prices cross, right? So you can see when prices cross, and then we're looking for a first or second touch of a moving average, right? And the same thing applies to the 21 and the 50 period moving average. So let's just go through this. We can see certain areas. Now we don't know if it's the first touch or second touch, but you can see that it did touch here. When prices cross above, you can start to see prices react. Again, it crosses the 50, then we get a reaction, crosses down, get a reaction from the 21, right? Crosses above, get a reaction, crosses down, get reactions, crosses above, get reactions, etc. Again, like any other support and resistance, prices can get weaker and do get weaker the more times that level is touched, right? We didn't get the reaction that we probably wanted, but prices crossed down and came up to the SMA right here after the first cross, right? Again, it crosses higher, prices react around here, prices react around here, and so on and so forth. You can see pretty much what's been happening. So with that being said, again, what we're doing is looking for supply and demand equations, and it's the same exact logic when we're looking at demand or supply zones in confluence with moving averages. Who's buying, who's forced to buy, or where's the forced demand and where's the willing demand within certain areas. So again, if we're looking at this price chart, we can see that traders who do use moving averages first touch within this demand zone. You can see here that prices did touch for the first time after prices did cross here, right? So this area here was the first cross, and now we get a first touch. But was that within the demand zone? No. So we're not looking at areas, you know, or moving averages within, outside of these areas, right? We're looking for moving averages within these demand zones. The second time, you know, it crossed down, right, and then crosses back up. So the first touch of the 21 within the demand zone is where we're looking to, you know, establish longs. And again, looking at forced demand, forced supply. If you are entering new trades, then this is going to be at this area, then this is going to be willing demand. If you've bought up here, right, or sorry, sold up here, got short, and you're taking profit down here, this is going to be forced demand. And again, traders use moving averages as profit targets because it's believed that prices, once they go above or they go too far away, they go quite a distance away from a moving average, you will tend to get a reversion back to a particular moving average. So traders will take short trades at levels and then try and trade them back to moving average bounces. So moving averages are also like reversion to the mean type trades, right? So short trades, you're going to be forced to do what? Take profit. That's forced demand. If you sold here, so that's forced buying. Willing demand from new traders who trade that kind of reaction to moving average, the dynamic support. And then we have value traders like ourselves who know this is a demand zone where we want to be potentially long as well. And again, same thing. If you sell, forced to take profit, which is forced buying, which is demand. Traders are going to be willing to get in, and then you've got value. And again, at each area, from a technical analysis perspective, what you're supposed to be doing is asking yourself, why is there going to be more demand than supply, or more supply than demand, right? Who is taking profit? Who is entering new trades? why is there going to be more supply at this level than demand, right? Or why is there going to be more demand than supply? And again, you can see, further up we get reactions around these areas. So let's look at supply zone level, and again we get the first, when prices cross down, cross back up, then cross back down. All right, now we're looking for areas within this supply zone. That's the reasons why we want to be short, if that's our fundamental bias. So we'll be buying the Japanese yen over the Australian dollar. You can see first touch of the SMA 100 right here. You can see the first touch of the 200 EMA right here. Again, it's a second touch within that area, and again we get reactions every time. So we get dynamic support, or dynamic resistance within an area of value. Again, if you're looking to buy here, trouble area is going to be your moving average, is your dynamic support and resistance, right? So you're going to be looking to sell here, forced selling. If you are a new trader looking to get in on that nice pin bar, right, and with the confluence of the moving average, you've got willing and then selling, so supply, and then you've also got value traders like ourselves looking to enter here, right? So value, so net we should have more supply, more supply, positive supply, and less demand at this area. Again, same thing applies for each reaction to the level. So lastly, one of the things you should keep your eye out on is round numbers, and round numbers are basically psychological numbers. My theory is that round numbers work because our affinity and conditioning to round numbers from when we're young and into adulthood, we tend to associate round numbers in all aspects of life. So for example, when I go to the gym, I might do sets of 10 reps, or whatever it is, or even from playing hide and seek with the kids, you count to 10, right, or count to 20 or whatever it is. It's rare that you're going to count to 7 or a random number like 11 or whatever it is. So I think that carries over into the forex markets. Maybe not, but that's my theory. And whatever the theory is, whether you agree with it or not, I think that there is some validity to round numbers, right? And I do see it work. You can see it in news publications and financial publications where they kind of will circle a round number as like a key level, right? For the exchange rate, etc. Right? So if we move on to an example of this on the price chart, and what we see is a level of demand, and then we will see traders who are again looking to either enter, right, so willing demand at certain levels, or they will be looking to take profit if they entered around here. So if you're selling again, then you'll be looking to take profit, and this is forced buying at this round number. And again, if you're looking to just enter a new trade, then this is willing buying at this area. And again, from a value perspective, this is value buying, which is what we do. So net we should have more demand at this level. From a technical perspective, then we should have supply who's going to be selling at a round number, especially when prices have made this kind of move here. You're basically selling at the lows. So we can see the reaction that it had, which is here, and then from a supply perspective, you can see the reaction that it did have as it had in the past. around here, and this is around the 1.82 round number. And again, if you bought around here, bought around here, and you ended up having to take profit around an area, your take profit is forced selling, then traders who just trade this round numbers is going to be willing selling, and then you've got value selling from us. So again, net you should have more supply than you do have demand at this level, right? But again, this is just some extra confluence within this area, right? And again, the supply and demand equation, we're just looking at the motives of traders around these areas. So just to recap, what we were looking for is obviously forced supply and demand, or willing supply and demand at areas of support and resistance. And the three areas of support and resistance, or categories of support and resistance, are really horizontal, diagonal, dynamic, and the round number is really just a bonus one that we look towards, right, when it comes to looking at an area. And this is where, we're looking to trade. So don't get this confused, right? Because earlier in the course we spoke about the creation of a demand zone, right? That's not to be confused with when we actually look to enter, right? So when we're looking to actually enter, right, so we have our demand zone and our odds enhancers, right? So odds enhancers, we have 4 main odds enhancers, and then when we're looking at the supply and demand equation, right, as to the reasons for our entries, this is where we are looking at the psychology of other traders and why there should be more demand, right, at this level, right, if we're looking to enter long, and why there should be less supply from a technical perspective. Remember, the number one odds enhancer for any technical analysis, right, that we do is fundamentals and sentiment, risk sentiment, right? So risk sentiment, that puts you on potentially the right side of the market. And just my opinion, that technicals are really just a reflection of the fundamentals and risk sentiment, right? So again, I advise you to watch the fundamental analysis course to catch up on the fundamentals, and it makes your life a whole lot easier. You're not trading at levels of supply and demand and trying to, because basically that's like trading support and resistance without knowing what, where value is, right? If you don't know what value is and what direction you should be buying, then that's the reason why a lot of people fail at technical analysis, solely because they don't understand value, right? Anyway, one of the things I wanted to touch on as well in the recap was just a few notes, right? So the more a support or resistance level is touched, the weaker it becomes, right? And that's obviously the same thing with supply and demand. And the more a level touched, just basically either lower your risk or don't take the trade, right? And again, supply and demand really is the most important thing. What we're looking for, is value, right? So we know that if that's a supply zone, right, everything else as far as the supply and demand equation, comes second or third. When it comes to, and I say second or third, I mean if, for example, this moving average has been touched, a few times, but we have a fresh level of supply, then I'm still going to take this trade based off of the fresh level of supply. I'm not concerned at the fact that this has touched a moving average, 3 times. If this is a fresh level and I've got fundamentals in my favor, right, and sentiment in my favor, right, and it's the direction that I should be trading. If this supply level had been touched, several times, for example, that's different, right? And let's say, for example, the moving average has only been touched once, but this has been touched 3 times, or more than 3 times, then I'm gonna be less inclined to take the trade, or I'm gonna take a very, very small position if the fundamentals and sentiment are still in play, right? So I'd say supply and demand zones come first, as this represents value, and then diagonal, horizontal, and dynamic support and resistance are in addition to that when trying to figure out why there are going to be more supply orders or demand orders at that area. Secondly, crowded exit, right? So crowded exit is where you have traders that will be looking at a particular level, right? And they will be looking to exit just before. Oh, sorry about that. Let's do that again. Try and draw a straight line, right? So let's say you got a reaction off that area here. And what a crowded exit is you don't want to be left holding the bag, right? You don't want to be left the trader who is trying to pick the absolute high if you've bought down here. Traders are gonna, basically look to exit anywhere once they make, the money that they want to make from a risk reward perspective. So what you don't want to do is look at a level and say it must absolutely touch, maybe a moving average. Yes, definitely you want to come within the supply zones and demand zones before looking to take the trade. But when it comes to maybe something like a moving average, if you don't get necessarily the absolute touch, you're a couple of pips away from it, don't worry, right? If you see an entry, maybe put your stop above, a proper distance above that moving average, just so that if it does spike through, it should still act as potential, resistance within that area of potential supply, right? But a lot of traders, going back to crowded exit, will look to take, profits early. So maybe, again, just keep in mind that if you are taking profit anywhere, you don't necessarily have to always look to take it at the absolute highs, right? And even entries don't necessarily have to be at the absolute highs. And I guess the more experience you get as a trader, you will start to see where crowded exits start to happen, and where crowded exits, if you get exits like that, and then what ends up happening is you tend to get, diagonal support and resistance from traders taking profit potentially early. Or I wouldn't say necessarily a trend line. It's more like where you get the market where it's like it does something like that, where it's like it's not as horizontal, but it's not, it's like slanted slightly, where traders are constantly taking profit before the highs, right? So that is actually a thing. So when taking profit, just make sure that you're not left holding the bag. And the market isn't perfect, right? The market isn't perfect, as we've seen from many examples where, you might get a level of supply, and then you might get a moving average, let's say, and then you might get, a level of potential previous, support term resistance. Sorry about this drawing, but you understand what I'm saying, where you've got support there, and then you've got a level of potential resistance, you've got a moving average, you've got a level of supply in this level here, not necessarily there, but you've got it right there, and the market will potentially, spike through, right, or go through, and then, reverse back. And just because the market has, closed above a level, right, doesn't mean that the level is gone. Right, it really doesn't. And I know it's taught widely online, but there is such thing as stop hunting. There is the zero-sum game in effect, right? For someone to win, someone else has to lose. There are hundreds of thousands, of traders within the market, position side, everyone's jostling for position, market manipulation, etc. going on, right? So for you to just, think that market's going to perfectly ping off of a certain level, right, whether it be supply, demand, the moving average, a diagonal support and resistance, or for even everything just to kind of line up within that area, right? It's the market's not perfect. What you should be doing is just looking at the price level. Is that an area where you think that is value? Place your stop loss where you think you're definitely going to be wrong about the area, right? And if you are wrong, then so be it. Manage your risk, etc. Right? Don't look to trade perfectly off of any kind of moving average or supply zone or horizontal support and resistance or diagonal support and resistance, right? Allow for some tolerance. Now, just want to get into maybe some examples, a couple of examples of, putting it kind of like all together, really. So, in this example, we can see where we have, again, areas that have been touched a few times, right? So you've got that area there, then you've got that area there, and then you've got a massive move. Traders will connect these levels, right? Connect that level and then project into the future. As you can see, we've got round number right here. We've got the supply zone from this area here. We have horizontal support and resistance where you've got support. You can see the round numbers have been reacted off of there. You've got a bit of support here, and now you've got some resistance. So net, you've got loads and loads of resistance and supply. Loads of resistance, loads and loads of supply coming into the market from various different disciplines of traders. You've got the traders who would have bought around here, again taking profit, forced to take profit at trouble area. So not only do you have willing supply from traders looking at pin bars, looking to get short, and then you have forced supply, right, from around here. And then you have obviously value supply, looking to get in. So net, you should have areas of supply. Why are traders, right, going to get long? Why is demand? Is the British pound undervalued here against the Swiss franc? Again, you would only determine that through fundamental and sentiment analysis. Can we look at, for example, pound yen, where you have horizontal support and resistance. So you've got area here, you can see it there and there, and you got it there, right? Got a bit right here, and then prices potentially should react from a horizontal perspective. You've got this diagonal area here. Again, traders would have been looking at that area here, comes down, bounces up. Traders are definitely looking at this area here from diagonal support and resistance perspective. And then what you also have within this area is first cross of this moving average, simple moving average, the 200 right here, and together with the demand zone, right? So if you want it to be a buyer of the Japanese yen, again, let's go through the forced and willing supply and demand orders, right? If you shorted anywhere around here, short, and pullbacks, right? The market made lower highs and lower lows. Where are people taking profit? TP, right here, which is forced supply. Sorry, forced demand. My apologies. Forced demand, because it's forced. You take profit as a buy order, it's just selling. You've got diagonal and horizontal traders looking to enter new traders, as well as moving average traders. So that's willing demand. And then you've got value traders like ourselves, value demand, right? Again, who Why is supply coming into this market from a technical analysis perspective, right? Let's go on to one more. This one happened recently, where you have again some support, so some resistance, support. Prices come down into this area here. You've got horizontal, you've got diagonal, you've also got the 100. You follow this one right here. First time it crossed, hasn't been touched, right within this area. And then we get the move. So why would there have been more supply in this area, right, when we've had traders who went short here, take profit here? So this is buy orders, new traders who trade these levels of support and resistance, dynamic, diagonal and horizontal buying. So that's demand, and then value, that's demand. Buy. Now, again, situations like this aren't necessarily the most common. You will have maybe two out of the three, mostly, to get 3 out of 3. So for example, dynamic, diagonal and horizontal all at the same time isn't necessarily a regular occurrence, but when you do get it, it's something that you should be taking if it's again alignment with your fundamentals. More than likely you will have 1 or 2 right out of the 3, but if you do get all 3, then this is like an A1 setup with your fundamentals and sentiment analysis, right? So hopefully that helps. Again, if you have any questions, just email me at info@trading180.com or Skype me, and we can have a chat about it. So take care, and speak to you soon.